Alfonso Cajero, A Journey into Finance History. Chapter 92. Cryptocurrency Regulations and Central Bank Digital Currencies, CBDCs. Development, 2020s. Governments explore digital currencies. In the early 2020s, a seismic shift began to unfold in the world of finance. This was not just a change, but the dawn of a revolution that would redefine the concept of money itself. The stage was set with the rise of cryptocurrencies, digital assets that promised a future free from the shackles of traditional banking systems. Bitcoin, the pioneering cryptocurrency, had already made headlines with its meteoric rise in value, capturing the imagination of tech enthusiasts and investors alike. As Bitcoin gained popularity, so did the interest in blockchain technology, the decentralized ledger system underpinning these digital currencies. This technology promised transparency, security, and efficiency, making it an attractive proposition for various applications beyond just currency. Governments and financial institutions watched closely, recognizing both the potential and the threats posed by this new digital frontier. Amid this backdrop, central banks worldwide began to explore the concept of central bank digital currencies, CBDCs. Unlike cryptocurrencies, which operated independently of any central authority, CBDCs would be digital versions of national currencies issued and regulated by central banks. This exploration was driven by several factors, including the need to keep pace with technological advancements, improve payment systems, and maintain monetary sovereignty in an increasingly digital world. China was among the first to take significant strides in this direction. The People's Bank of China, PBOC, had been researching digital currency since 2014 and launched pilot programs for its digital currency electronic payment, DCP system, by 2020. These pilots were conducted in various cities, allowing residents to use digital yuan for everyday transactions. The results were promising, showcasing the potential for increased efficiency and reduced costs in the financial system. In the United States, the Federal Reserve also began to explore the possibilities of a digital dollar. The central bank conducted extensive research and consultations, considering various design and policy implications. The aim was to ensure that any digital currency would complement the existing financial system rather than disrupt it. The Federal Reserve's cautious approach reflected the complexities involved in implementing such a transformative change in a highly developed financial ecosystem. The European Central Bank, ECB, joined the fray with its own digital euro project. Recognizing the need to innovate while preserving the stability of the financial system, the ECB embarked on a multi-year investigation phase. This phase involved consultations with various stakeholders, including financial institutions, technology providers, and the public. The ECB's goal was to design a digital currency that would be secure, inclusive, and efficient, catering to the diverse needs of the Eurozone. These developments were not limited to major economies. Countries around the world, from Sweden to the Bahamas, were exploring their own CBDC initiatives. Sweden's Riksbank, for instance, was working on the e-krona, motivated by a significant decline in cash usage among its population. The Bahamas launched the sand dollar, aiming to enhance financial inclusion in its archipelago of islands. These initiatives highlighted the global nature of the digital currency revolution and the varied motivations driving different nations. The rise of cryptocurrencies and the exploration of CBDCs were not without challenges. Regulatory frameworks had to be developed to address issues such as consumer protection, anti-money laundering, and financial stability. Governments had to strike a delicate balance between fostering innovation and safeguarding the financial system. This necessitated collaboration between various regulatory bodies, financial institutions, and technology companies. As the 2020s progressed, the conversation around digital currencies became increasingly prominent. Conferences, seminars, and webinars were held worldwide, bringing together experts from different fields to discuss the future of money. The media played a crucial role in disseminating information, helping the public understand the implications of these developments. Public opinion was divided, with some embracing the potential benefits of digital currencies and others expressing concerns about privacy and security. The dawn of the digital currency revolution was a time of excitement and uncertainty. It was a period of exploration, experimentation, and innovation. Central banks and governments were embarking on a journey into uncharted territory, driven by the promise of a more efficient and inclusive financial system. The world watched with bated breath as the foundations were laid for what would become one of the most significant transformations in the history of money. While central banks were cautiously navigating the waters of CBDCs, the cryptosphere was experiencing an unprecedented boom. The early 2020s saw an explosion of new cryptocurrencies, each promising unique features and use cases. Ethereum, with its smart contract capabilities, emerged as a formidable competitor to Bitcoin. Other cryptocurrencies like Ripple, XRP, Litecoin, and Cardano also gained traction, each contributing to the vibrant and rapidly evolving ecosystem. The decentralized finance, DeFi movement took the cryptosphere by storm, offering financial services such as lending, borrowing, and trading without traditional intermediaries. DeFi platforms like Uniswap, Aave, and Compound leveraged blockchain technology to create decentralized applications, dApps, that enabled users to transact directly with each other. This democratization of finance was lauded for its potential to increase financial inclusion and reduce dependence on centralized institutions. However, the rapid growth of the cryptosphere brought with it a host of challenges. The lack of regulatory oversight led to concerns about fraud, market manipulation, and consumer protection. High-profile cases of hacks and scams highlighted the vulnerabilities in the system, shaking public confidence. Governments around the world grappled with the question of how to regulate this new asset class without stifling innovation. In the United States, the Securities and Exchange Commission, SEC, took a proactive stance, scrutinizing initial coin offerings, ICOs, and classifying many tokens as securities. This classification meant that these tokens had to comply with existing securities laws, which involved stringent disclosure and reporting requirements. The SEC's actions aimed to protect investors and maintain market integrity, but they also sparked debates about the appropriate regulatory approach for such a novel and rapidly evolving sector. The Financial Crimes Enforcement Network, FinCEN, also played a crucial role in regulating cryptocurrencies. It implemented regulations requiring cryptocurrency exchanges and wallet providers to comply with anti-money laundering, AML, and Know Your Customer, KYC requirements. These measures aimed to prevent illicit activities such as money laundering and terrorist financing, which were perceived as significant risks in the largely unregulated cryptosphere. Across the Atlantic, the European Union introduced the Markets in Crypto Assets (MiCA) regulation. MiCA aimed to create a comprehensive regulatory framework for cryptocurrencies and digital assets, providing legal certainty for businesses and protecting consumers. The regulation included provisions for asset-backed tokens, stablecoins, and utility tokens, ensuring that each category was appropriately regulated. MiCA was seen as a landmark effort to harmonize crypto regulations across the EU, fostering innovation while safeguarding the financial system. China took a different approach, cracking down on cryptocurrency activities while advancing its CBDC initiatives. The Chinese government banned cryptocurrency exchanges and ICOs, citing concerns about financial stability and capital flight. Despite the crackdown, China remained a significant player in the global cryptocurrency market, with many of the world's largest Bitcoin mining operations located within its borders. The government's dual approach of promoting CBDCs while restricting private cryptocurrencies underscored the complexities and contradictions in its policy. Japan, on the other hand, embraced a more balanced approach. The Financial Services Agency, FSA, established a licensing regime for cryptocurrency exchanges, ensuring that they met stringent security and operational standards. Japan's regulatory framework aimed to foster innovation while protecting consumers, making it one of the most progressive crypto regulatory environments in the world. The country also explored the concept of a digital yen, conducting research and pilot projects to assess its feasibility. As the regulatory landscape evolved, collaboration between regulators and industry stakeholders became crucial. Organizations like the Financial Action Task Force, FATF, provided guidelines and recommendations to ensure a coordinated global response to the challenges posed by cryptocurrencies. The FATF's travel rule, which required virtual asset service providers, VASPs, to share customer information for transactions above a certain threshold, was one such measure aimed at enhancing transparency and combating illicit activities.